Hello and welcome to SwitzerTV. I'm Peter Switzer. On tonight's show, we brace ourselves for a bit of a sell-off for stocks with the coronavirus infections rattling Victoria and large chunks of the USA. We're holding our breath to see how Wall Street responds to rising infection rates in the US, and we want to ask our experts how they are set to play a stock market that has been rising strongly to one that is now going off the boil. Over the weekend, the Dow lost 2.8% and our market on Monday gave up close to 2% as well. So is this the start of something bad? I'll put this question to Berman Invest's Julia Lee, Airlie Funds Manager Matt Williams, and my Switzer Report colleague Paul Rickard, who has a set of stocks to buy in a serious sell-off situation. And the founder of Beta Shares, Alex Vinokur, comes with a new ETF that gives you all the local tech stocks in one ETF. It has everything from Afterpay to REA to Tyro in one virtual stock. So without any further ado, let's catch up with Julia Lee. Well, as we do each week, we catch up with Julia Lee to see how the market's going and what she's liking and not liking right now. Thanks for joining us, Julia.
Great to be here, Pete.
Okay, let's kick off a couple of things. The market was down today. I wrote something in the Switzer Report today looking at 10 reasons why the market might go down after such a strong rally. What do you think is going to happen to the market in the coming weeks?
Look, we were selling out of some positions last week and taking profits in anticipation for a little bit of weakness. And I suppose the reason why we have been buying puts and some protection in the portfolio is in case we do see extra volatility coming in July. And Pete, I see two reasons why that might occur. One, we are seeing an acceleration in COVID-19 cases in the US, so watching that very closely and the impact it has on the world's largest economy. And secondly, if we have a look at here in Australia, July is traditionally confession season, where companies give us an update on what to expect for the full year numbers before the full year reporting season in August. So given all the disruption, we are expecting to hear some soft reports coming through. I guess the big question is whether that's already priced into the market or whether we see further weakness.
What about Alan Joyce's revelation that we won't be travelling overseas until the middle of next year? That really has hurt the likes of Webjet and Flight Centre. Do you think that their pain is permanent, or they'll eventually get a recovery once we can see some light at the end of the travelling tunnel?
Yeah, I think that there are opportunities there, but those opportunities are now further out given the developments that we are seeing in some of the biggest economies in the world. And the fact that we are seeing rising cases still in places like the US, Brazil, and India means that international travel, as we know it, is probably off the cards for at least a year, if not a couple of years, and 2 or 3 years to get back to more normalized conditions. So look, investors had initially been pricing in a year of disruption, and now that's gone out to 2 to 3 years. So I don't think there's a huge rush at this stage to get in on the travel stocks. And of course, we have seen those travel stocks being impacted negatively. So even things like Sydney Airport, you'd expect to see a bit more weakness come in. And obviously, we've seen weakness in the likes of Webjet, Flight Centre, as well as corporate travel. So look, those travel-related stocks that are related to international travel, I think definitely some weakness there. And instead, I think it will be domestic travel that Australians will be focused in on. So maybe we'll do more driving holidays, so the petrol stations might benefit.
Okay, so have you pinpointed any stocks that are going to benefit from an Aussie economy that will be domestically focused? And I know I wrote a story where I actually said that we have to get used to not going to Europe or the USA, but maybe going to Margaret River or Cable Beach or Northern Territory, because that's where our one-time tourist dollars used to be spent, but now will be spent at home. So there must be businesses that will benefit from that.
Yeah, well, when we look at Qantas and even the old Virgin, there was an international travel component to it, but there are a couple of airlines here in Australia which are very domestically focused. So I guess regional airlines, or REX as we know it, did see a sharp increase today on expectations that it's going to start traveling to the capital cities. So if you want a pure domestic play, something like regional airlines, I guess has a great track record and less risk given the international travel component isn't there. So look, regional airlines has been well supported on the back of that. But as I mentioned, I think more people will be driving. So anything related to driving, whether you're looking at Babcock, whether you're looking at the petrol stations, I think that we'll see some strong support there. And then, of course, as people lack confidence because of these COVID-19 flare-ups, I think that people's footprints just get smaller and their world gets smaller, which means that some of those more local supermarkets like Metcash, which we do own, I think are a beneficiary. And Metcash's last update just over a week ago, they said that they saw very strong sales coming through in April, May and June, whereas some of the larger supermarkets started to see a bit more normal conditions coming through in the latter months. But it looks like Metcash, the customers have been sticky and they've been shopping local.
And I guess, when you think of, people like you and me and my wife Maureen, when we go overseas, we buy a lot of stuff. And if we're not going overseas, we'll be buying stuff here. So a lot of, like clothing stores and stuff like that could get, a much better period for the next 12 months or so. Like, I guess good old Solomon Lou will be happy about that.
If there were all sorts of different fashion companies listed on the market in clothing, I would be short suits and long tracksuit pants because
Yeah.
working from home, look, we're not going to have those.
Lululemon stuff.
That's right. And look, some of that we have seen come through. Accent has been doing very well, which owns Athlete's Foot, Platypus, and Hype DC, which is more sneaker type of businesses. So people are obviously still walking around their neighborhoods. They're just not wearing their dress shoes. So we have seen some of those companies doing well. But anything that's related to work from home, that trend is likely to continue to be a bit longer now. We're seeing those COVID-19 flare-ups.
Okay. One of the questions we got on my Boom Doom Zoom show for our subscribers to the Switzer Report was about a company called Bid Energy, and Paul Rickard and myself didn't know much about it. What do you know about Bid Energy?
Look, it is a smaller company and usually I cover the larger end, but it's an interesting company. BID is a stock code. I think it has a market capitalization of around about $100 million. And while it says Bid Energy, it's not really an oil and gas stock. It's a billing company. So you're looking at the digitalization of billing for utilities like energy companies. I think that Origin Energy is a customer, as well as water companies and any other type of other companies out there. And I think COVID-19 is good news for companies like this because we are seeing a migration to the digitalization of services. The last update that this company gave was back in April, and what they did see was expected customer revenues, given that the contract wins that they had seen for the quarter was up 19% quarter on quarter. So it's hard to see that type of growth coming through for a lot of companies on the stock market. It is a smaller company and it is dependent on those contract wins, but it operates not only here in Australia, but the US and the UK. So they're the three key markets. And look, I think it's pretty exciting. It should be moving towards profitability either now or in the next 6 months.
So it's an interesting company on your radar.
It is an interesting company. It's too small for me or the fund because we look at ASX 200 companies. But having a look at this company, you're looking at the digitalization of bills. And look, I'd have to say that that's a growing market.
Yeah, exactly right. One final one. We're getting close to June 30. Tax loss selling. What's your take on that?
Well, Pete, we definitely saw it today. I mean, the ASX 200 is down 12% in the financial year to date. And if you have a look at the top 10 losers on the ASX 200, in today's market, when the market was down 1.5%, those top 10 averaged a loss of 5.5% on the market today. So some pretty steep losses. And over the last week, those top 10 are down 12% compared to the market, which is down 2%. So it definitely looks like some tax-related selling coming into play, with some investors looking to crystallize losses. And the thing with tax loss selling is it generally is a little bit reversed in July, or the first couple of weeks of the financial year. So if anyone's looking for a bit more of a short-term play, then generally you see these names bouncing back over the next couple of weeks.
So therefore, if you don't hold those stocks, by buying them tomorrow when more tax loss could be on, you might get some joy in July sometime.
Look, it depends on the market conditions, but certainly some interesting ones out there, like Media, which has been sold down very heavily, as well as Oil Search. You've seen Virgin Money coming under pressure as well.
So when you said top 10, are they the top 10 losers? For the year?
They are the top 10 losers, because end of tax year, usually you're looking at people crystallizing losses, which means they sell their losing positions.
Great stuff, Julia. Great. Thanks for joining us. Talk to you next week.
Thanks, Pete.
Well, the market looks as though it's set for a bit of a sell-off, but we don't know how bad it will be. Paul Rickard has looked at a number of stocks that he'd be willing to buy if there was a sell-off, and a few stocks he wouldn't want to touch if there is a serious sell-off. Paul, let's have a look at this table you presented here.
Yeah, I thought a good way to look at what to buy in a second wave, Peter, is to look at what happened during the first wave. Doesn't mean history's going to repeat itself. We don't always get a carbon copy, but you've got to expect that some of the behaviours we saw back in February, March, April will be the same in a second wave. So not exactly the same, but I think it's a good guide. So just recall what happened. The market peaked about February the 20th, Peter. That's when it hit 7163. We hit the bottom on March the 23rd. It only took 5 weeks to get down there from 7163 down to 4546. We made our way back to the next peak on June the 10th at 6148, and we've come back a little bit since then. So top to bottom from those 2 dates, it went down 36.5%. It's gone back up 35.2%. But
how much do they have to come back to get back to where they started from?
36 down is not equal to 35 up. It's got to be 36 down. It's got to be about 57% up. So we got back about 2/3 of the way that was required.
Yeah, we're about 20% short or so from where we're. Okay, so let's go and talk about the stocks that you like. If there's a sell-off, basically this is the buying opportunity stocks, aren't they, Paul?
Yeah, I mean, look, really one of the big lessons for the sell-off, Peter, and I'll show some of the data in a sec, was really that the best companies did best. That is, the companies, the sort of the stocks I'd describe as the ones that you always want to buy for a decade, right? Either because they're always growing, they've got a dominant market position, strongest balance sheet. They actually held up the best. So let me just show you a couple examples to demonstrate that. First of all, in the banking sector, compare CommBank and NAB. CommBank's the market leader. It's so far in front of the other banks. It only went down about 38%. The NAB went down 49%. Westpac and ANZ were between 45 and 47%. So of the 4 stocks, Commonwealth Bank only went down this much, the others went down that much. And I think if you're looking to buy a bank in a fall, you would buy Commonwealth Bank over the other 3. Conversely, it didn't come back as much, but it didn't have as much to go through. The other company I want to highlight there is CSL, Peter. This is, I think, a company for the next decade. It only lost 16.7%.
Which says a lot.
Which says a lot about it. Hasn't come back as much, but one of the reasons it didn't come back as much is the Aussie dollar went up. And if anything, it's been held back because it earns so much of its revenue in Australian dollars. Another stock to highlight there is right at the bottom, Peter, is Xero. I reckon Xero is a terrific business. It only lost 32.8%. Compare that to, say, Afterpay above at 77% in the same sort of tech domain. And it's come back 44%. It's almost as high as it was when it hit the peak around about February 20. So, in fact, I think it's made a new fresh peak since February 20. So that's what I'd say is a company to look to buy in a market collapse.
Yeah, but Paul, talk to the fact that Afterpay is up 512%. Something irrational has happened there.
Yeah, I mean, look, I think, Afterpay, I don't think anyone could believe the $8.90 it got to. Now, it's something higher than this. It's gone higher than June 10. It's around about $56, $57. And it come back 512%. So look, a huge win back. I think the other thing that's happened, Peter, is there has been a new tailwind that Afterpay and some of the other payments companies have got, because clearly, cash is on its way out. Yeah. The way people are going to purchase online is changing. That's playing into the hands of people like Afterpay, as a lot of generation of people won't get credit cards, and so it has got a strong tailwind behind it, which you could say has been helped a little bit by the pandemic. But I think it's more of a function of, Peter, it just got to, sometimes when markets panic, everything goes down, and it just got to some absurd levels, and people, one stock. You also remember the Tencent came in after that.
Yeah, the Chinese are bought into
and said, look, this is a great company, and that probably showed the way for a lot of Australian investors.
Okay. Is there any other story on there, like you got Flight Centre? Is this a company you want to buy on a soft, Paul?
No, I don't want to buy Flight Centre.
Yeah.
I think that second time around, Peter, I think it was easy the first time around. I think the market still believed in the prospect of a V-shaped recovery. And certainly, if not an economic V-shaped recovery, we perhaps an easier, lockdowns coming out quickly, travel restrictions would go. I think if there's a second wave, Peter, a lot of those assumptions about both the V-shaped recovery and, how preparedness to open up borders and for people to take the next leap. I mean, there's a confidence issue here as well. I think it's going to be really hard for the travel companies. So I think whereas it was a great tip that you gave back in late March, early April, to buy the Flight Centres and the Webjet and the Qantas, I don't think if there's a second wave, Peter, I'd be saying the same.
No.
The other one I talk about is Woolworths. Woolworths, it actually went up, or it did really well in the move down. I think people obviously saw the sales, but they forgot about some of the costs, which was always going to be there. But I've got a feeling that some of the defensive stocks, Peter, are going to do better in a second wave, because I think the second wave sends a story that, as I said, it's more likely to be a W or a U-shaped economic recovery. That means a hard slog. It means it's going to be really tough for some of the stocks to get their earnings back up. And I think defensive stocks, because of the reliable income, less uncertainty about revenue, might just do a little bit better. So I think the other thing is to look at for some cheaper defensive stocks in a sell down.
I guess when you look at CSL and Woolworths, both of them didn't fall much, they haven't come back much, but they are solid companies when people get scared. Yeah,
they're going to be in business in the next 10 years, 20 years. I think CSL, it's just more the currency impact, Peter, I think has probably stopped it. But look, I think it's one... if you get a whip down and there's a bit of panic, that's a company to load up on. Yeah. And I think Woolworths is probably almost getting towards the same situation, simply because it's been held up in the recovery.
Okay, that's Paul Rickard looking at the stocks to buy if there is a serious sell-off. Well, everyone would like to beat the ASX 200 index, and one guy who's going to be trying to do it in the company of someone like Hamish Douglas from Magellan is Matt Williams from Airlie Funds. Matt, thanks for coming on the program.
Thanks, Peter.
Tell us what this product is that you're doing in concert with Magellan.
Yeah, so Airlie is a wholly owned business within Magellan, but Airlie concentrates on Australian shares only. Magellan, obviously, the experts in global investing. Yep. So the Airlie Australian Share Fund is basically a long-only ASX-dominated fund. And the innovation that we've brought with Magellan, who've come up with this, is that previously, if you wanted to have a listed fund and a managed fund, you basically had to have two separate pools of money. Even though you might have run them the same, you had two separate. Now, we've basically got one pool of money, but you can come in at either via any entry point. So you can come in via a platform, or you can fill out the forms, or you can buy it on the ASX with the ticker AASF, but basically you're then part of one big pool managed fund. So we think that's quite interesting. We think a lot of other managers will be interested in that. It lowers the cost for the fund managers, and hopefully it's it's something that retail investors will like to do. Just buy it on market, buy a managed fund on market. Okay,
so let me get this right, because people would have heard what you've said then, and not been completely sure. They understand the ETF part. That would be a listed ticker code. What is the ticker code going to be?
AASF.
Good. Okay. Not as good as Switz. I got lucky. They gave me my nickname. But on the other side, it sounded like a unlisted type product that people are used to going to a managed fund. Is that right?
That's right. So it's traditional, on the unlisted side, it's just the traditional managed fund.
Yeah. Will there be a unit price and which will be calculated on a daily basis?
That's right, yeah, exactly. But then then it's just basically, it's the same fund, but you can just access it on market. Yeah. And you're in the same pool of money.
And I guess there are people out there who have been used to listed funds and they would like that if they've had a good experience with it. But I would have figured like younger, more online investors would be more used to the ETF one, and that's probably, you're catering for two sorts of audiences.
That's right, yeah, you're spot on. I think there's so many people, as I've travelled around talking to advisors around the country, financial advisors, there's so many now looking to go direct for their clients, direct into the market via an ETF or other sort of listed vehicles. So there's much more interest in bypassing the unlisted world and just going straight to listed.
Okay, we should explain to people, some people might have heard the name Airlie, would have probably read it in newspapers like the AFR and the Australian when you guys were quoted, but you really haven't been in the retail space before, have you? What have you been doing?
Yeah, so Airlie was started by John Sevior in 2012. I and the co-manager of this fund, the Airlie Australian Share Fund, Emma Fisher, we joined in 2016. John and I had worked together previously for quite a few years. And then in 2018 we joined Magellan, we merged with Magellan, and in that same year we started this unlisted retail fund. So traditionally Airlie has been institutional. So the big super funds, they're clients of ours, they give us money to manage on their behalf, and that's been our traditional business. But now with the Airlie Australian Share Fund, we're branching out into the retail space.
Is a part of it, apart from leveraging off your good reputation, which you wouldn't argue with me on that point?
No, absolutely no.
But because there is a much greater appetite to invest in the stock market now, so therefore it just seems sensible to actually be closer to the people with the money rather than waiting for the money to go through advisors and then to you.
Exactly. So advisors, platforms, then to us, or from advisor to us. Via the unlisted, it's just a much simpler way, we think, and we think this is the way the future of the managed funds business will probably go over the next few years.
What do you think is your competitive advantage? What do you, apart from your great reputation and your self-belief, what is Airlie's competitive advantage when it comes to how you get? Because ultimately you want to beat the ASX 200 index. Otherwise, people may as well just buy an ETF for the index.
Exactly. I mean, that's the reason we get that's the reason we get up and do what we do. We've got to try and beat the index, and as we know, just beating the index a little bit each year. Hopefully, you beat it a lot, but by beating it just a little bit each year, the compound effect of that is quite significant on people's savings over a long period of time. That's the whole reason for active management.
Well, but Matt, and I'm going to push you because you would have thought about it, and a lot of people who watch this show are learning about investing. The passive investor who goes into an ETF, they're just getting what the index is going to serve up. Fine. Lots of fund managers can't beat the index. How have you worked out over the years that you can beat the index? What is it that a fund manager can bring to the table that can anticipate the sort of problems that a market might face, and therefore you avert them and then end up with a better return?
Yeah, look, even my self-belief wavers in certain periods because all active fund managers will have a period of underperformance, and I've certainly had those. But over the long term, we've seemed to have managed to do it, and my track record shows that. But there is periods where it's you start to think this is hard, this is too hard. But basically, the competitive advantage any fund manager has is their process and how they implement that process and whether they're disciplined to that process. Because I think a lot of fund managers say they have a process, but when the market is doing something, the fads are there, some hot things are going and you feel like you're missing out.
Like after pay at 10 going to 50.
That could be, you could say that, something like that. And you lose discipline, and when something crashes down, the fads crash down, like the tech boom. Let's go way back then. The leveraged sort of the businesses that were highly leveraged in the before the GFC. So those kind of things. And so by sticking to our process that we have, we find that we miss out on a lot of these, these busts. I guess we do a lot better than the market when these busts come along.
Hence the track record. How are you investing now? Because it's a tricky market right now, isn't it?
Well, I think tricky is the understatement. I think it's a very confusing. I mean, it's a amazing market. The word adjectives have lost their meaning. I think unprecedented, all that. It's just it's quite unusual. But when we look at the economic data and some of the retail data, we're doing so much better than what we were thinking. Only a few months ago. It's quite extraordinary. But then everyone's thinking, well, we're all thinking, what's going to happen when this stimulus, this amazing stimulus that we've got going, it falls away. And so this is why it's such a confusing time. The market has priced a V-shaped recovery. The data certainly looks like that's occurring, but we all know that this is a bit of a false sort of situation. So much money's been pumped in. We all know about some people. We all know people who are actually earning more as a casual worker than they used to before.
And cafes in the suburbs are getting Saturday and Sunday trade 7 days a week at the moment.
That's right. Yeah. So when all this falls away, it's going to be very interesting to see what happens.
When you look at America, they've rebounded ridiculously, 7% off their high. Do you think there is a bit of this young person or novice investor going online and just pumping up the stocks because they can't believe how easy this is?
Well, they're pumping up certain stocks, the Robinhood traders in Hertz and things like that. Tesla's probably been a beneficiary.
Probably the FANGs as well?
Yeah, they're too big. I think that to say that the whole market's been pushed by this these new traders is wrong. No, it's definitely wrong. I think it's more to do with all the unprecedented monetary stimulus. The monetary stimulus being pumped into the system globally is twice what we had in the GFC. So.
And was introduced faster than we've ever seen before.
Exactly. So what happens from here is that this is where does the monetary stimulus fall away whilst the fiscal stimulus falls away? It's a very confusing period for
investors. We're in the hands of treasurers and central banks.
Yes.
So let's just ask this question then, because a lot of people will be wondering: do you think that it's likely that there's going to be a second leg down because of the infections escalation? And if so, do you think that second leg down will be less than the first? And be right too, Matt.
Look, I think it's entirely possible that that we do get a leg down, given the hard sort of rally we've had. There's nothing very insightful about that that view. It's entirely possible. But do we retest the lows? Probably not. I think I don't think so. I think something catastrophic would have to happen for us to retest the lows. So I think it won't be as bad as that again.
Okay. So when does this fund kick off?
It's listed now. You can buy it through your broker, through your CommSec account or whatever account you might have, and the ticker is AASF.
Okay. So Matt, what are the stocks you like right now?
It's hard to find a lot of great, bargains that you think are really cheap at the moment. We've had a lot of good performers, good winners, and look, this goes to show one company we've had a lot of. It's been a big position in our fund is Mineral Resources. It's a mining services business, but quite a unique one. Much more of a stable kind of business than you've seen in others. It also has its own iron ore operations. It's net cash on the balance sheet. And so they're just now sifting through a heap of opportunities that the crisis has brought up, and they've got a great track record of investing and making a lot of money by buying at the right time and selling at the right time. So we think it's now they're going to do that again. But the stock's gone from $13 to $20. We've actually reduced a few, but I still think on a 3-year view, this is a really good company. And I can see it at $25 within to $30 in.
And I guess if there was a sell-off, this is the kind of company you'd buy more of. We'd
buy it back. And because it's been such a big position, we have trimmed the position lately.
Any others?
Look, what we've been selling, I think we've always liked TPG, and we've loved the TPG Vodafone merger that's occurring, and suddenly the market has fallen quite in love with that at the moment too. So at $9 though, we think it's a bit of a long road to haul, putting these two companies together, getting the synergies, trying to ramp up the selling process and the bundling process and start to eat into Telstra and Optus. It's going to take a while. So at $9 we've been selling.
Yeah. And what price would you buy back in?
When it's got a 6 handle.
Great stuff.
Yeah.
Matt, thanks for joining us.
Thanks, Peter.
That's Matt Williams from Airlie Funds Management. Well, everyone likes to invest in tech stocks nowadays, but which one do you invest in? BetaShares has created a new fund, a tech-oriented ETF, and Alex Vinokur from BetaShares is here. Alex, great to see you again, mate.
Likewise, Peter. Good to see you.
Tell us about this new ETF you've created.
The new ETF we have recently launched is trading on the ASX under the ticker ATEC, and it is the S&P ASX All Technology ETF. It's quite an exciting development for BetaShares. We've launched our business about 10 years ago, and we have really launched our business with the purpose of providing investors in Australia with value-adding investment solutions. And when we looked at the Australian market 10 years ago, what we've observed is that Australian portfolios have very heavily skewed towards the traditional blue chips. And we're talking about the banks, we're talking about the resources companies, telco allocation here and there in the supermarket. That's essentially the core of the Australian portfolio when you look at most statistics. Whereas most people allocate to equities for the purposes of achieving growth. Right? You allocate to fixed income, to cash, for other things, for more defensive exposures, but equities is about growth. Yeah. Now, when we looked, and this is the exercise we've undertaken 10 years ago, when we've looked at the Australian market, we felt there are some key growth components that are missing. And technology is definitely one of them. And I personally have a passion for technology. I'm a big believer in disruption and entrepreneurship, which is why I've obviously started the business with my team at BetaShares. And we have set out on a bit of a mission to bring genuine global growth opportunities to Australian clients. So we have started with our NASDAQ 100 ETF, NDQ, which is the first of its kind in Australia, still is, and of course that includes your Amazons and Facebooks and the FANGs basically as we tend to refer to them now. We have then taken our focus to Asia, and we've launched an ETF called the Asia Tech Tigers, which gives you the Asian technology leaders, the Tencents and Alibabas, etc. We've got a phenomenal, even though it's still small on relative basis, a phenomenal and exciting technology sector now on the ASX, which we didn't have 10 years ago. Yep. And we thought it's quite exciting and it's quite fitting in many ways for us to be the firm to bring an ETF, ATEC, which allows Australians now to get exposure to a portfolio of leading Australian technology companies as easily as buying a share on the ASX.
Yeah. And now, one of the things you have also brought to the table is a gift in coming up with great names, like ATEC, Australian Tech. All right. Just give us some of the other ticker codes that you've come up with.
Oh, look, I mean, HACK is a good one. That's a global cybersecurity ETF.
Beauty,
that's not so bad. USD is the US dollar ETF.
Yeah.
I mean, we've got a few.
Yeah, you've done well.
We've got a few. Drug is the global healthcare ETF. I mean, but I must disclaim at this point in time that none of the credit belongs to me here.
No.
This is all teamwork. This is not Alex Vinokur work.
Yeah. You're a techie kind of guy, Alec. Not a creative.
I'm not a creative guy.
No, but still, we like you. All right, now, this ATEC, how many stocks will be in it?
So the portfolio consists of 50 stocks at the moment. When the ETF started trading on the ASX first, it had a portfolio of 46, and in the most recent rebalance, there have been a few stocks such as Tyro and Temple & Webster that have joined.
Have crept in, and Tyro's been a good performer as well.
It's been a good performer.
So, what is the criteria for putting companies in the tech? So,
well, like with all ETFs, one of the key criteria that we look at is liquidity, is ensuring that the company is above a minimum market cap threshold, which in this case is over $100 million. And in addition to that, ensuring that there is enough liquidity in the stock. That's one of the key criteria, basically. So market capitalization and liquidity.
Yeah, and so a lot of people watching the show might not know what you mean by liquidity. Explain what it means in relation to the stock and why it's important.
Yes. First and foremost, free market capitalization, basically. So free float.
Not held by a small number.
Indeed.
Close owners or something, whatever. So something that can buy and sell on the market pretty easily.
First and foremost.
Okay.
In addition to that, on-market liquidity. So one of the things that's critical with an ETF, and this is a big distinction here to be drawn between a closed-end listed investment company and an ETF, is that every day there is net buying in an ETF. The fund manager, as in beta shares, will go and acquire the underlying stocks, basically, in the open market. And vice versa, when there is net selling, the ETF will sell the underlying stocks. So liquidity of the underlying portfolio is absolutely critical. And the criteria that we use for ATEC is the same criteria, say, as we use for the NASDAQ 100 ETF. So index construction rules are quite robust.
Okay. What else does someone need to know to be comfortable about buying this tech stock?
Look, the critical thing with technology allocation, in our view, is that it is a high growth sector, and high growth also means high volatility.
Yeah, it can go in both directions.
It can go in both directions.
Yeah.
And this is an example where the magic of diversification definitely plays its role.
Yeah.
I mean, we have seen some of the market darlings, Afterpay. Afterpay, which has been a strong performer, of course, has suffered quite a significant market drawdown when the COVID panic hit. And the sell-off was quite violent.
Yeah.
And of course, the recovery has been spectacular
Quite violent as well.
Indeed, the recovery has been spectacular as well. But the importance of diversification here cannot be understated. So the one thing we always talk about to our clients is not to have, importance of not having all the eggs in one basket. And I think in the technology, which is a high beta exposure, basically, the technology sector, diversification definitely pays dividends. Importantly as well, the index does a lot of the heavy lifting for the investors. Because of the quarterly rebalance that it undertakes, what it means is that some of the winners of the future may not be in the index today. And if you're an investor who is simply trying to pick stocks by herself or by himself, you may pick a few stocks that you like today, but you also need to remain extremely vigilant to make sure that A, they remain appropriate for the future, but B, you also continue allocating to those that are coming in. So here, the beauty of the index methodology is that it continues doing the heavy lifting for the investor, and those companies that will be long-term winners in the technology space will be included in the index methodology.
Okay. So, Alex, when you think about it, when you started a long time ago, 10 years, did you always think that you'd have such a big supermarket of ETFs? Because that's what you've basically created, like a supermarket of ETFs where people can go down a corridor with the trolley and say, I have a bit of tech, I have a bit of, you can bear the market or you can gear the market, all these sort of things you've done. Was that always the plan, or did it evolve as you saw the kind of appetite for ETFs?
I suppose, like all good things, it's an evolutionary process. I would say that sitting here right now, we're almost 10 years into the journey. We launched our first ETFs in December 2010, and we had zero under management. Today we have over 11.5 billion under management in over 60 funds, and of course, I would say, when we sat down and put together the initial business plan for beta shares, yes, we thought there are some great opportunities to bring innovation, true innovation to market. But I think it's also fair to say that investor preferences and investor needs change over time.
Yep.
So, if we take our cybersecurity ETF, 10 years ago, I would not have thought that there is an opportunity to bring a cybersecurity ETF, or that cybersecurity would in fact start replacing physical security as the more important measure for people keeping their information or their wealth safe. So there is always opportunity to iterate. I think you also learn a lot of lessons. I think there's no doubt about that. We have learned a lot about the investor base in Australia. We have got a lot more trust, of course, as a business than we've had 10 years ago, and that's not something that we ever take for granted. We've got to work every day, having to earn that trust. But having tens of thousands of investors that interact with us on a regular basis gives us a phenomenal insight as to what's relevant in the market and what's not.
Okay.
So we kind of evolved from doing our own desktop research and a bit of guesswork in early days to now having most of our decisions informed by clients.
Okay, just two other questions. The importance of market makers. A lot of people don't understand what market makers do, but basically they ensure that when people want to sell, they can get out, and when they want to buy, they can buy, right? So what have you learned about market makers?
Market makers in the Australian market and global ETF markets have performed a very important function now for several decades. So first ETFs have been launched in Canada, of all places, about 30 years ago. They have been in Australia for almost 20 years. And they have been in the US, in Europe, everywhere around the world. And market makers' job effectively is to provide liquidity. The reason they can provide liquidity, as we were alluding to a bit earlier in the conversation, is because the underlyings of ETFs are themselves liquid. So the market maker's job is effectively to ensure that people can buy and sell throughout the day with certainty of the price. And this is to go on a little bit of an anecdote, which is COVID related. We've seen some days in the Australian market where the market's opened, 5 or 6% down, and then by the end of the trading day was actually up 3%. And this is a fantastic illustration of the benefits of ETFs in that you can buy and sell at a price that is known to you and at the price that you're comfortable with. Compare that to an unlisted managed fund. And I'm not here to advocate for passive versus active. I definitely think there is scope for both under the sun. But I certainly believe strongly that ETF is a more evolved way of investing. So if you were a managed fund investor and the market opened 5% down, and you think, hey, I want to buy manager ABC, actively managed fund because the stocks have fallen and I'm getting a bit of a bargain. Well, your units, when you are filling out your application form, get issued at net asset value at the end of the day. And guess what? When times are volatile, at the end of the trading day, when you looked at it at the beginning, it was -5, it might have closed +4. Yeah. So you've got a 9% differential basically between the open, effectively a 9% mismatch in your expectation as an investor and the result that you receive. So the beauty of an ETF is that certainty. And market makers, going back to your original point, they allow that to take place.
Okay, last question. About 3 or 4 years ago, you remember it, there was a bit of speculation that ETFs, they'll really cop it when there's a big market sell-off. And I copped a lot of crap on Twitter because I said, well, I think these guys will be okay. And they said, oh no, you'll find out. Well, you had a pretty serious test recently, and you must have been worried that there was bad publicity coming around at that point in time about ETFs under stress. Are you happy that how ETFs have weathered this storm?
I'm delighted with how the ETF industry, not just BetaShares ETFs, how the ETF industry has weathered the storm. I would also add that previous storms in the global financial crisis, in the Brexit shakeout, in the NASDAQ boom and bust, have all been experienced with ETFs passing those tests with flying colors. But yet again, it's good to have the opportunity to dispel some of those myths. And what I would say is that hopefully coronavirus doesn't kill many things, but if there's one thing that I think coronavirus may have killed is the myth that ETFs are not going to deliver.
Okay, Alex, thanks for joining us. That's Alex Vinokur from BetaShares. And if you're looking for great investment ideas from some of the best investing minds in the country, there is one day to go to take up our exclusive end of financial year Switzer report offer. Along with your subscription, you'll receive the free copy of my book, Join the Rich Club, as well as a bonus 2020 tax tip ebook. See the link in the description for more details. And thanks for joining us, and I'll see you next week.